Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Allegiant just completed its acquisition of Sun Country for $4.10 a share, FedEx spun off its freight division, and crude oil is still trading north of $106 a barrel. I'm Sarah.
And I'm Mike. This week showed us what aviation looks like when capacity gets pulled out of the system while costs stay elevated. We've got insider buying across multiple names, defense contractors beating expectations, and a travel demand picture that's frankly underwhelming.
We'll dig into that Sun Country Allegiant deal, break down why RTX's earnings beat matters more than the headline suggests, and figure out what's driving the coordinated weakness across airlines despite that ceasefire extension.
Plus, we need to talk about Boeing. $220 after starting the week at $238. That's not just sector weakness.
This week's narrative was industry consolidation accelerating while operational costs remain structurally elevated, forcing a fundamental reset in capacity discipline and route economics.
Right? And you're seeing that play out in real time. Spirit's shutdown removed, competitive pressure, Allegiant's buying Sun Country for scale advantages, but the underlying cost structure still isn't cooperating.
Operationally, airlines are having to optimize for margin over growth because jet fuel at $163 per barrel doesn't leave room for capacity expansion mistakes.
For investors, this creates a weird dynamic where consolidation should be bullish long-term, but the market's focused on near-term margin compression from these cost pressures.
Exactly. And when you look at the travel demand data, TSA screened 12.7 million passengers this week, up 6.1% year over year, but only 3% above the 3-year average.
That's not exactly robust growth to offset the cost headwinds. Business travel up just 0.7%, according to the Travel Association data from this week.
The most important signal this week came from the consolidation activity, specifically how Allegiant structured the Sun Country deal and what that reveals about capacity discipline becoming the dominant strategic framework.
Operationally, this signals that mid-tier carriers can't survive independently in this cost environment and need scale to maintain route profitability.
For investors, it means we're moving into a period where M&A premiums reflect operational necessity rather than growth synergies, which changes how you value these assets.
All right, let's get into the price action because it was pretty brutal across the board. Airlines led the decline with JetBlue down 7.66%, Boeing falling 7.44%, and Archer Aviation off 7.49%.
The standout loser was VSE Corporation, down 11.24%. That's the MRO services company, and when maintenance providers get hit that hard, it usually signals airlines are deferring non-critical maintenance spend.
Which makes sense when you're dealing with elevated fuel costs and weak demand growth. You defer what you can defer.
On the flip side, Lockheed Martin managed to gain 0.7%, L3Harris up 0.3%. Defense held up while commercial aviation got hammered.
That's the geopolitical premium. Even with the ceasefire extension, defense budgets aren't shrinking, and these contractors have multi-year backlogs that insulate them from cyclical swings.
The cargo names, FedEx down 0.8%, UPS down 1.07%. That's interesting because the FedEx Freight spinoff was supposedly positive news.
Markets treating the spinoff as a sign that integrated logistics isn't working anymore rather than value unlocking. When you have to break up the business model, maybe the business model was the problem.
And then you've got the engine manufacturers really struggling. RTX down 4.16% despite beating earnings, GE down 6.4%.
That RTX move is what caught my attention. They beat on both revenue and EPS, $22.08 billion versus $21.38 expected, $1.78 versus $1.68.
And the stock still dropped 4%. That tells you something about expectations versus reality in this environment.
What matters is that even the companies executing well can't escape the broader cost pressures and demand uncertainty. The market's not rewarding operational excellence right now.
The more important signal behind these numbers is that we're seeing a fundamental repricing of aviation assets based on this new cost structure, not just temporary weakness. The first supporting signal here is that management teams are using this environment to accelerate strategic repositioning, and you can see it most clearly in the M&A activity and capital allocation decisions.
Starting with that Allegiant Sun Country deal. 410 a share when Sun Country's been trading around $3.75 to $4. That's not a huge premium for a strategic acquisition.
Right, and the structure matters. It closed on May 13th as a cash and stock deal, but look at the Sun Country 8K filed that same day. The tax receivable agreement termination triggered an $80.4 million payout to existing holders,
including CEO Jude Bricker, who then immediately got restricted stock as part of the integration. So management's getting paid twice, once for the TRA termination, once for staying through the transition.
That's actually smart deal structure. You're eliminating future tax obligations and locking in management continuity. But from an operational standpoint, this deal is about route density and aircraft utilization efficiency.
Sun Country's been operating that hybrid model, scheduled service plus charter work. Allegiant's betting they can optimize that capacity better than Sun Country could independently.
And when you look at Allegiant's Form 4 filing from May 15th showing Bricker's 40,000 share sale at $75.21, that's tax withholding on the restricted stock grant, not an exit.
Which suggests management's bought into the integration thesis. You don't stick around and take equity if you think the deal's going to destroy value.
The second piece of evidence here is FedEx spinning off the freight division. That 8K filed May 13th shows shareholders getting one FedEx freight share for every 2 FedEx shares held.
But here's what's interesting. The market treated that as negative for the parent company. FedEx down 0.8% the day after announcing the spin-off completion.
Because investors are reading it as admission that the integrated model isn't working anymore. When you spin off a division, you're essentially saying we can't manage these assets together as effectively as they can be managed separately.
Which raises questions about UPS since they're still trying to make the integrated logistics model work. That 8K from May 13th about Kevin Warsh leaving the board to become Fed chairman.
That's actually a bigger loss for UPS than it seems. Warsh brought serious financial markets expertise to their strategic thinking. Losing that perspective right when logistics companies need to rethink their capital allocation is bad timing.
And you're seeing similar strategic repositioning across the defense contractors. That Northrop Grumman $325 million Range Hawk contract from May 15th.
That's high-altitude long-endurance testing infrastructure. Basically, they're building the systems that will test the next generation of defense platforms. It's a bet on multi-year modernization cycles.
RTX is making similar moves. Their earnings beat was driven partly by new defense contracts, including that CRAM ship defense system for Australian frigates. They're expanding into Asia-Pacific naval defense, just as tensions with China are escalating.
The filing tone across this week's filings was pragmatic repositioning rather than defensive. These aren't companies battening down for a recession. They're actively restructuring for a different operating environment.
The common thread was management teams using current market conditions as cover to make strategic moves they probably wanted to make anyway. Spin off underperforming divisions, acquire smaller competitors, lock in defense contracts with longer duration.
Which brings us to the insider activity. We saw buying across multiple names, Hexcel Director purchase, Alaska Air Director grants, even some controlled selling at higher levels that looked more like portfolio management than panic.
That Hexcel Director buying 254 restricted stock units at around $88 to $89, that's not exactly buying at a discount, but it's buying at current market levels.
The second supporting signal is that operational execution is diverging sharply between companies that have pricing power and those that don't, and the market's starting to recognize that divergence in real time.
You can see it most clearly in the defense versus commercial split. RTX beats earnings, stock drops 4%, Lockheed gains 0.7% just on sector momentum. That's not random.
Defense contractors have multi-year contracts with escalation clauses. When input costs rise, they can pass them through, or they're protected by cost-plus structures. Commercial aviation companies are taking jet fuel at $163 per barrel with limited ability to raise ticket prices immediately.
And the travel demand data backs that up. Business travel growth of 0.7% means corporate customers are still price sensitive. Leisure travel is holding up better, but that's the segment most vulnerable to fuel surcharges.
Look at the earnings quality differences. RTX's $22 billion in revenue included significant defense contract wins. Meanwhile, the airline Form 4 filings show executives selling stock. Frontier's SVP of Operations sold 83,000 shares at $541.
That's above the current stock price of $503, so either he timed it well or he knew something about the trajectory that the market didn't.
Or more likely, he's managing personal liquidity because he expects continued volatility. When airline executives sell stock in this environment, it's usually defensive portfolio management, not confidence in operational turnaround.
But here's where I disagree with you on the divergence. I think the market's overshooting on the commercial aviation pessimism.
How so?
TSA numbers up 6% year over year. Memorial Day travel bookings are solid according to the industry data, and we're still dealing with artificially constrained capacity because of Spirit's shutdown and the Middle East routing restrictions.
That's fair, but the margin structure has fundamentally changed. Even if demand recovers fully, airlines are operating with jet fuel costs that are 50 to 60% higher than their pre-geopolitical crisis budgets assumed.
Right, but capacity discipline should eventually allow pricing to catch up. Allegiant buying Sun Country removes a competitor. Spirit's gone. Route optimization from the airspace restrictions is forcing better utilization metrics.
I'll give you that the capacity reduction should help pricing eventually, but the timing matters for investors. How long does it take for fare increases to offset fuel cost inflation?
Historically, about 2 quarters if demand holds up. The question is whether demand holds up long enough for that repricing cycle to work.
And that's where the business travel weakness becomes crucial. Corporate accounts are the margin drivers for major carriers. If business travel growth stays under 1% while fuel costs remain elevated, the math doesn't work.
Unless you're positioned like Alaska Air, which has that West Coast route density and can charge premium pricing for connectivity that competitors can't easily replicate.
Which explains why their director was comfortable taking equity compensation at current levels. Alaska's got structural advantages that should allow them to pass through cost inflation more effectively than a Southwest or a Frontier. Segment 7. Divergence, Sector Positioning. This brings us to our divergence framework, and I think we need to tackle the fundamental question. Are we looking at cyclical margin compression that recovers with demand normalization, or structural changes that permanently reset the profitability dynamics of this industry?
That's the critical distinction, and honestly, I'm seeing evidence for both sides. The cyclical case is pretty straightforward. Fuel costs are elevated because of geopolitical tensions, capacity is artificially constrained due to Spirit's shutdown and routing restrictions, and travel demand is still normalizing post-pandemic.
But the structural argument is equally compelling. Labor costs have permanently reset higher across the industry. The Boeing production constraints aren't going away quickly. And we're dealing with increased regulatory oversight that's adding compliance costs.
Okay, but let's parse this out sector by sector, because I think the cyclical versus structural distinction plays out differently across aviation subsectors.
Start with the airlines, since that's where we're seeing the most pain. JetBlue down 7.66% this week, Alaska Air down 5.43%. Is that cyclical demand weakness or structural margin compression?
For the network carriers, I'd argue it's primarily cyclical. United, Delta, American, they have the route density and corporate contract structures to eventually pass through fuel cost increases. The question is timing and demand elasticity.
But look at the low-cost carriers. Frontier down 5.57%, Allegiant down 5.64%, even after completing an accretive acquisition. The LCC model might be structurally impaired in this cost environment.
That's where I see the structural argument most clearly. LCCs built their business models on fuel efficiency advantages and cost arbitrage versus legacy carriers. When fuel costs spike to these levels, that advantage gets compressed, and they don't have the pricing power to offset it.
Which explains why Allegiant's buying Sun Country. It's not growth-oriented consolidation, it's defensive consolidation to maintain margin structure through scale economies.
Right? And Spirit going out of business removes the most aggressive pricing competitor from the market. That's structurally positive for LCC pricing discipline going forward.
But here's my concern with the structural thesis for airlines. If fuel costs moderate and capacity utilization improves, couldn't we see a rapid margin recovery? Airlines have high operating leverage when things go right.
Sure, but you're assuming fuel costs moderate. With Brent at $106 and ongoing Middle East tensions, that's not guaranteed. And even if fuel costs drop, the elevated labor agreements are locked in for years.
Fair point. Now flip to defense, where we're seeing completely different dynamics. Lockheed up 0.7%, L3 Harris up 0.3. Is defense resilience cyclical or structural?
I'd argue that's structural strength. Defense budgets are increasing across NATO countries. The modernization cycle is multi-decade, and geopolitical tensions are escalating rather than resolving. That's not a cyclical upturn. That's a structural shift in global security spending.
And the contract structures protect margins. When RTX beats earnings despite input cost inflation, that's because their defense contracts have escalation clauses or cost-plus structures that airlines don't have.
Exactly. Plus, the barrier to entry in defense is massive. You can't just start a new defense contractor the way you could theoretically launch a budget airline. The moats are deeper and more permanent.
But here's where it gets interesting. What about the defense-exposed industrials like Boeing or even RTX's commercial aviation division? Boeing down 7.44% this week.
Boeing's in a weird middle ground. Their defense business benefits from structural tailwinds, but the commercial aviation side is dealing with production constraints that are arguably structural rather than cyclical.
Right, because the MAX production issues, the 787 manufacturing problems, the regulatory oversight, those aren't cyclical demand issues that resolve with economic recovery. Those are execution and compliance issues that take years to fix.
And when you're Boeing's major customers, like United or Delta, you can't just switch suppliers easily. So Boeing has pricing power on the aftermarket and services side, but they're capacity constrained on new deliveries.
Which creates this weird dynamic where Boeing's commercial business has structural headwinds on volume, but structural tailwinds on pricing. The question is, which dominates over the next 2 years?
I think pricing wins because aircraft scarcity is more severe than demand weakness. Airlines need planes to replace aging fleets and accommodate route expansion, even if that expansion is happening more slowly than pre-pandemic.
Now let's talk about the supply chain and component companies, because that's where I'm seeing the clearest cyclical versus structural divide.
Components and aerostructures got hammered this week. Hexcel down 5.84%, Howmet down 4.84%. But I think that's oversold based on cyclical fears rather than structural deterioration.
Why cyclical rather than structural?
Because aircraft production isn't disappearing, it's just shifting timelines. The Boeing delays push component demand forward, but they don't eliminate it. And the defense component demand is actually accelerating.
But Hexcel and Howmet are leveraged to commercial aircraft production rates. If Boeing and Airbus can't ramp production due to supply chain constraints, then component suppliers face volume pressure regardless of end market demand.
That's true near term, but it sets up a better long-term dynamic. If component suppliers use this period to optimize capacity and reduce fixed costs, they'll be positioned for higher margins when production rates normalize.
The MRO sector is where I'm most confused on cyclical versus structural. VSE Corporation down 11.24%. That's either severe cyclical deferral of maintenance spending or structural changes in how airlines approach MRO.
I think that's cyclical deferral. Airlines defer non critical maintenance when cash flow gets tight, but they can't defer it indefinitely. Safety regulations and insurance requirements force catch up spending eventually.
But what if we're seeing permanent changes in MRO practices? More predictive maintenance using data analytics, longer intervals between major overhauls, different approaches to component lifecycle management.
Those trends were already happening pre pandemic. I don't think current cost pressures are accelerating technological disruption in MRO as much as they're just causing temporary spending deferrals.
Let's wrap this framework discussion by applying it to specific positioning decisions. If you believe the cyclical thesis dominates, you want to buy cyclically depressed names that recover when conditions normalize.
Right? And that would point to oversold airlines with strong route networks, component suppliers trading below historical multiples, and maybe even Boeing at these levels if you believe production issues get resolved over 2 to 3 years.
But if you believe structural changes dominate, you want defensive positioning in companies with pricing power, contractual inflation protection, and business models that benefit from industry consolidation.
Which points to defense contractors, aftermarket services providers, and maybe the surviving LCCs after weaker competitors get eliminated.
The challenge for most investors is that we're probably dealing with both cyclical and structural factors simultaneously, which makes clean positioning decisions difficult.
Agreed. You probably want some exposure to both themes: cyclical recovery names for when conditions normalize, and structural winners for the new operating environment.
The key insight from this week's data is that the market's still figuring out which factors are cyclical versus structural, which creates opportunities for investors who can make that distinction more accurately than consensus. Segment 8. Week ahead. Looking ahead to next week, we've got earnings season continuing with several key names reporting, plus some important industry data releases and potential policy developments.
The big one is Raytheon Technologies reporting on Thursday. After this week's 4% post earnings decline, despite the beat, the market's clearly reassessing what constitutes good news in this environment.
RTX's guidance for the rest of the year will be crucial. They've been managing supply chain constraints better than peers, but if they have to revise production timelines or margin expectations, that could pressure the entire aerospace supply chain.
Plus, we get Boeing's monthly delivery data, probably around Tuesday or Wednesday. After the 7% decline this week, any sign that deliveries are stabilizing could provide some relief.
But honestly, I'm more focused on the Boeing regulatory updates. We're expecting potential FAA comments on the MAX production rate increases, and any pushback there would be significant.
On the airline side, we should get more complete TSA traffic data for the full Memorial Day travel period. This week's 6% year-over-year growth needs context from the holiday weekend numbers.
And early June booking data starts becoming available. If we see weakening forward bookings despite capacity reductions, that would validate the demand concern narrative that's been pressuring airline stocks.
There's also the monthly oil price information service, jet fuel price data, typically released midweek. Fuel at $163 per barrel has been a key pressure point, so any moderation there would be positive for airline margins.
Don't forget the potential for more consolidation activity. With Spirit Out and Allegiant Sun Country completed, there's speculation about other mid-tier carrier combinations.
Right, and that Alaska Air Director buying at current levels suggests management's not worried about near-term integration costs if they were to pursue additional acquisitions.
From a policy perspective, we're watching for any updates on the Middle East airspace restrictions. The ceasefire extension was positive, but airlines need clarity on routing normalization timelines for long-term capacity planning.
And the FAA budget discussions continue in Congress. Defense spending gets most of the attention, but FAA operational funding affects certification timelines and oversight capacity.
On the data front, we should get updated aircraft order and delivery statistics from both Boeing and Airbus. Recent weakness in new orders would signal airlines pulling back on capacity expansion plans.
The international travel data becomes important too. Domestic TSA numbers are solid, but international route profitability depends on business travel recovery, which has been lagging.
One wildcard is potential M&A activity in the defense sector. With budget increases locked in and private equity looking for stable cash flows, we could see consolidation among smaller defense contractors.
That Northrop Grumman Range Hawk contract this week signals DoD is moving forward with next generation testing infrastructure. Other contractors want that business, so competitive bidding could intensify.
From an investor positioning standpoint, next week's data will help clarify whether this week's broad-based weakness was indiscriminate selling or fundamental deterioration.
The key metrics I'm watching: RTX guidance, revision magnitude, Boeing delivery numbers versus expectations, and TSA traffic trends through the first week of June.
Plus, any insider buying or selling patterns. This week's mixed signals from management teams suggest they're as uncertain about near-term direction as public investors are.
If we see continued insider selling at airlines but buying at defense contractors, that reinforces the sector divergence thesis we've been discussing.
The earnings guidance revisions will be particularly telling. Companies that maintain or raise guidance despite cost pressures have genuine competitive advantages. Those that cut guidance might be facing structural rather than cyclical challenges.
And watch the commentary around capital allocation. Companies talking about increased M&A activity or accelerated share buybacks signal management confidence in long-term positioning.
Next week should clarify whether we're in a temporary air pocket or beginning a more fundamental repricing of aviation sector valuations. Segment 9. Closing Synthesis. Wrapping up this week's analysis, the overarching theme was industry participants using current market conditions as strategic cover for positioning decisions they probably wanted to make regardless of the cycle.
Right, and that dynamic creates investment opportunities for those who can distinguish between companies making defensive moves and those making offensive moves. Allegiant buying Sun Country is offensive positioning for market share gains. Airlines deferring maintenance spending is defensive positioning.
The price action this week, with VSE down 11%, Boeing down 7%, but Lockheed gaining ground, reflects the market beginning to differentiate between companies with structural advantages versus those facing structural headwinds.
But I still think we're seeing some indiscriminate selling that's creating opportunities. RTX beating earnings by 6% and falling 4% is disconnected from fundamentals.
The key insight from our analysis is that investors need to look beyond headline financial performance to understand how different business models respond to the current cost and demand environment.
Defense contractors with multi-year contracts and escalation clauses are structurally advantaged. Airlines with route density and corporate contract pricing power can eventually adapt. But airlines dependent on leisure price sensitivity or component suppliers leveraged to production rates face genuine challenges.
Looking forward, the catalysts that could change current trajectory include fuel price moderation, capacity utilization optimization from industry consolidation, and potential demand acceleration from business travel normalization.
But the timeline for those catalysts remains uncertain, which means investors need to position for multiple scenarios rather than betting everything on cyclical recovery or structural deterioration.
The most important takeaway from this week's developments is that aviation industry value creation is shifting from growth-oriented to margin-oriented strategies, which changes how you evaluate both individual companies and sector allocation decisions.
This week demonstrated that operational excellence and strategic positioning matter more than market timing in the current environment. Companies that executed well and made smart strategic moves were rewarded, while those that didn't were punished regardless of external factors. The industry is consolidating around structural advantages rather than cyclical opportunities, creating a multi-year investment framework where defensive positioning and competitive moats determine relative performance outcomes.
That's our analysis for this week. Thanks for listening to Aviation Intelligence Weekly. Disclaimer: The content presented in Aviation Intelligence Weekly is for informational purposes only and should not be construed as investment advice, recommendations to buy or sell securities, or a substitute for professional financial guidance. All opinions expressed are those of the hosts and do not represent the views of any affiliated organizations. The information discussed, including SEC filings, stock price movements, earnings data, and industry analysis, is based on publicly available sources believed to be reliable, but has not been independently verified. Past performance does not guarantee future results, and all investments carry inherent risks, including the potential loss of principal. Listeners should conduct their own research and consult with qualified financial advisors before making investment decisions. The aviation industry involves particular risks, including regulatory changes, fuel price volatility, geopolitical events, and operational disruptions that may significantly impact company valuations and sector performance. This podcast may discuss forward-looking statements and projections that involve uncertainty and risk. Actual results may differ materially from those discussed. No warranty is made regarding the accuracy, completeness, or timeliness of any information presented. Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Want the inside track on aviation's biggest players? Aviation Intelligence Weekly brings you expert analysis of airline earnings, breaking industry news, and deep dive company histories. From American Airlines to Boeing, we cover the business of flight every week. Subscribe now on Apple Podcasts, Spotify, or wherever you listen.